timber sales and income. A very short, non-controversial topic. You can see the short time that was set aside for it. All right. In the 1996, there was a tax act passed that I always called the Tax Complication Act. But since then, we've had three additional tax acts that makes the tax code even more complicated. Okay, and since we are talking about timber sales, we are talking about, they can save you a hard time. This is where we're required to notify the IRS. Now, producing timber is probably the slowest way I can think of to get rich quick. But we are going to have to notify the IRS. Okay, where we're talking about in the Ag Handbook here is from pages 45 through 57, so you can see that's a large chunk of the Ag Handbook also. But this talk is updated for the Economic Growth and Tax Relief Reconciliation Act of 2001. That's one of the three new acts I was talking about earlier. Also, the Jobs and Growth Tax Relief Act of 2003. So this law is called EGTRA by its those of us who know it intimately. And so this one is called JEGTRA. We've got EGTRA and JEGTRA. And also now we have the American Jobs Creation Act of 2004, which people just call the Jobs Act. We don't have an acronym for it. Okay, so it's you can see this is an area where the Ag Handbook is considerably in need of updating. So when you talking about timber income, when you sell or exchange standing timber, both the amount and the type of income that you receive are important. The amount is pretty straightforward. It's a price that you receive for the timber minus your expenses of the sale, minus your timber basis like we talked about this morning. So the difference then, what's left over, is your income. But the type can either be an ordinary income or a capital gain. And the type is important. The Economic Growth and Tax Relief Reconciliation Act created a new 10% bottom bracket for ordinary income, so that brought it down towards the capital gains rate, and scheduled rate reductions for the top four brackets. JEGTRA accelerated those reductions, making them effective immediately in January 1st of 2003. All right. JEGTRA also reduced the tax on long-term capital gains, though, from 20% down to 15%, or from 10% down to 5% for amounts that would be in the bottom two tax brackets if it was ordinary income. And that goes down to 0% in this lower amount goes down to 0% for 2008. So there's still a 5 to 20%, depending on what bracket you're in, for the ordinary income, a 5 to 20% tax rate differential between ordinary income and long-term capital gains that favors long-term capital gains. So if you have a choice, you have long-term capital gain than ordinary income. Other reasons that beyond the rate that the type of income is important. First of all, if your forest qualifies as a trade or business, like Larry was talking about earlier before lunch, any ordinary income that you earn from that timber is going to be subject to self-employment taxes. And if you add those all together, the rates are as high as 15.3%. If you have large capital losses, you can only apply them against $3,000 of ordinary income per year, but you can apply them against any amount of capital gains. And if you're retired, capital gains do not count toward the amount of income that you can earn before your Social Security benefits start being eaten into. Okay? So for lots of reasons, you'd rather have a capital gain than ordinary income. So how do you go about qualifying for capital gain treatment? Historically, there's been three elements that determine whether income you received for your timber qualifies for capital gain treatment. And that was, first of all, your primary purpose for holding the timber, how long you held it, and lastly, how you disposed of it. Timber that you held for, so we'll talk about those one at a time. So the purpose that you held it. Timber that you held for personal use or as an investment is a capital asset in your hands. So there's no question a gain from a sale or exchange of that timber is always going to be a capital gain. Timber that you use in a trade or business, though, is not a capital asset, but the gain from a sale or exchange can qualify for capital gain treatment. The second of the three determinants was how long you held it. So the holding period for long-term capital gain treatment depends on how you acquired your timber. Okay, like this morning, your original basis. So if you acquired it by purchase, you need to hold it over 12 months. For timber that was sold between these two dates in 1997, it was over 18 months when EGTRA created a new midterm capital gain rate and holding requirement. Second, if you acquired your timber by gift, again it was over 12 months, over 18 months for timber that was sold between these two dates in 1997. But this includes the time that the donor held it. So the donor may well have met the holding requirement by the time that you received it as a gift. And then third, if you acquire the timber by inheritance, there's no requirement. The theory being, I guess, that the decedent met the holding requirement. All right, then this holding period is measured from the date of acquisition, which is pretty straightforward, to the date of disposal, which sounds pretty straightforward, but we're going to talk about 4 different definitions now of date of disposal before I finish with this talk. Okay, so it looks innocent, but it gets complicated. And the third, determining how you dispose of it. You can qualify for capital gain treatment if it's a lump sum sale or exchange under the provisions of Internal Revenue Code Section 1221 or 1231. You can also Section 631B disposal can qualify either through a pay-as-cut contract, or this is new, this wasn't here up until this year, or outright sale beginning next year. Third way you can dispose of timber and qualify for long-term capital gain treatment is through a Section 631A transaction by cutting the timber yourself and converting it into products for sale, and then making an election. This is critical, to make that election on an original, timely filed tax return. So let's talk about those one at a time. First, lump sum sale, what that is an outright sale of standing timber, for example, through a timber deed or a sales contract, for a fixed total amount that's agreed upon in advance. You can sell all the timber on a tract, or only certain species, or only certain sizes, or even only individually marked trees. So a lump sum sale doesn't automatically mean a clear cut. For a lump sum sale, date of disposal, here's the first of the 4 definitions, is the date that the ownership of the timber changes hands. So when you sign the sale contract and get your money, get your check, then that's the date of disposal, even though the trees are still standing out on your property. Okay, now income from the sale of timber that's held for personal use or as an investment, okay, either personal use property or investment property, qualifies as a capital gain, no question. It's a capital asset in your hands. So the sale of that timber qualifies as a capital gain under Internal Revenue Code Section 1221. It's going to be a long-term capital gain if you've held it for the required 12 months, and a short-term capital gain if you haven't. And you don't want a short-term capital gain because that's taxed at the same rate as ordinary income. Income from the sale of timber that you hold for use in a trade or business that you do not hold primarily for sale to customers can qualify as a capital gain under Section 1231. Again, it's a long-term gain if you've held it for the required period, or a short-term if you haven't. There's 4 tests to determine whether that timber actually is a capital asset in your hands, which makes the sale a capital gain, or if you hold it primarily for sale to customers, that makes the profit ordinary income. So let's look at the 4 tests. The first is your purpose for acquiring or holding the timber. If you hold it as an investment, it argues that the income is a capital gain. Or if you hold it primarily for sale to customers, that argues that the gain is ordinary income. The second test is the number, continuity, and frequency of sales. If the sales are isolated events over your lifetime, that argues that it's a capital gain in your hands, and the proceeds from the sale that it's a capital asset in your hands, and the proceeds from the sale are capital gain. Or if you make it frequent sales, like every year, that argues that you hold it for sale hold the timber for sale to customers, and the income then is ordinary income. All right, third test is the extent to which you solicit or promote sales. If you wait for buyers to contact you, that argues that the income is a capital gain. Or if you go out and actively solicit the sales, that argues that the income is ordinary income. And the 4th test is the facts and circumstances test. You've already heard that term today, and you'll hear it more times. If the facts and circumstances of your situation indicate that this timber sales is part of your occupation or contributes substantially to your livelihood, that argues that the income you receive from the timber sales is ordinary income. The problem is the tests are not determinative. There's no rule that says you have to meet 1 out of the 4 or 3 out of the 4. And even cases that you or I would look at and say these are identical cases have led to opposite results in court decisions. So the tests aren't determinative. So up until the end of this year, that's going to be a big deal. You don't want to hold yourself out as active in the trade or business the whole time that you're growing timber. So you can aggressively deduct your expenses, and then in the year that you sell it, say, I'm an investor this year, so I can sell it lump sum and have it be a capital gain. Okay, the IRS would come back, and it has in several cases in the South, and said, well, no, the facts and circumstances of your case indicate that there's ordinary income in your hand, and you owe us a whole bunch more tax. Okay, after December 31st of this year, though, or after December 31st of last year, at the end of last year, this is no longer a problem. Income from the sale of timber that's held for use in a trade or business that you do hold primarily for sale to customers can also qualify as a capital gain. This is accomplished not by a change in the wording of Section 631B, not by a change in the rules for lump sum sales, but a change in the rules for 631B, the disposal that was put in place by the American Jobs Creation Act. All right, if you have a lump sum, if you have a capital gain from a lump sum sale, you report it on Form 1040 Schedule D. If it's a long-term gain, it goes down on the bottom on Part 2. If it's a short-term gain, it goes up at the top on Part 1. It's going to be combined with other capital gains and losses, and then the net gain or loss transferred to Form 1040. You report any ordinary income from a lump sum sale on Schedule C for a business, or Schedule F for a farm. You give the details of the sale, including how you calculated your deductible basis, your timber depletion deduction, remember, on Form T Part 2, or on a plain piece of paper, Form 3P. I'm going to show you Form T Part 2. With the new rules, you want to use Form T Part 2 for this particular requirement. All right, so let's work through an example of a lump sum sale. You remember that timber tract that you all bought this morning 6 years ago, right? And then at the end of last year, you updated your timber accounts. So let's say that this January, sometime this month now, a timber buyer approaches you and offers to buy the older plantation, the 20 acres that has merchantable timber on it, saw timber, some saw timber. You agree. Your only expense is $350 to have your lawyer check the sales contract. Let's show how to calculate and report your proceeds from the sale. Okay, as a reminder, that merchantable saw timber subaccount contains 590 cords and 112,000 board feet of volume basis and $38,396 of value or cost basis. And the older of the two stands, the one that you're selling, contains 390 cords of pulpwood and all 112,000 board feet of the saw timber. All right, so let's calculate your timber depletion allowance and adjust your timber basis. Where you would do that is on Form T Part 2. We're not going to do this for this particular example. I'm going to save showing you how to do this to the next example when we make a 631V disposal. So let's allocate the sale proceeds. So you have gross sale proceeds of $37,000. That's what the buyer who knocked on your door offered you. Minus you have $350 cost of the sale. And minus your depletion deduction, that's $34,379. And I'm going to ask you to just take this number by faith now, and I'll show you where it comes from next example, okay? So you're going to have a Section 1221 gain of $2,271. Okay, so how much money did you receive for the timber? Somebody can. Right, you received in your hand $37,000. All right, now from that sale, how much of that is taxable income to you? Only $2,271, right? Okay, and it's a capital gain to boot, right? All right, so let's look at Form T Part 3. All right, so Form T Part 3 is profit or loss from land and timber sales. So here's a timber sale. All right, on line 34, the name of the block and the title of the account is going to be your timber account. The legal description, this is another place where that big long paragraph goes in this little squinchy line. So it's going to flow over to a Form 3P. Line 36A is the buyer's name and address and the date of the sale. All right, on line 37 is the amount that you received. We're saying $37,000 all in cash. No interest-bearing or non-interest-bearing notes, no other consideration that you have to explain. So the total amount received for the property was $37,000, okay? Now you have to put up with my handwriting on this particular line because there's a glitch in this form and it's not possible to enter a number on that line, okay? Now these are the numbers that you've taken on faith so far. We have 390 cords. You know that's how much pulpwood you're selling. 112,000 board feet of saw timber. You know that we know that's how much you're selling. But the basis, what you're taking on faith, is that the basis in the pulpwood is $7,832 or $20.08 a cord, and the basis in the saw timber is $26,547 or $237.03 per thousand. Okay, so that adds up to the $34,379 figure that you're just accepting right now. This is the lawyer's fee to check your contract. So you subtract these two numbers down here on line 39 H and I from the number up here on line 40 H and I. You subtract them from the number on line 39. So you have that's the $2,271 that you're going to wind up paying taxes on, okay? Okay, and then where you report that taxable income is on Form 1040 Schedule D. It should be the next page in your forms handout. Okay, remember it's not up here on, we'll fill out the top. So your name and your Social Security number go up at the top just like a Schedule A. Then down here in Part 2, the long-term capital gains and losses for assets held more than 12 months. Okay. Line 8, the description of the property's merchantable timber, the date you acquired it 6 years ago, the date that you sold it this year. The IRS is going to look and see, check whether these are actually more than 12 months apart. All right, now it's not 12 months, it's more than 12 months. So they need to be more than 12 months apart. The sales price is the $37,000 that the buyer offered you. The cost or other basis is that your basis in the timber plus the $350 for the lawyer's fee. So the difference then in column F is your gain of $2,271. It'll be combined with your other long-term capital gains and losses, and then the total here is going to go actually on to the back of the form, which guides you through a series of worksheets. It used to be about 30-something lines on the back of the sheet, but now it's so complicated that they've given up putting it on a single sheet of paper altogether. And in the instructions to this form, there's a whole series of worksheets that helps you calculate your tax. Okay, so you've determined your taxable long-term capital gain, and you've reported it to the IRS on Schedule D. That was the lump sum sale. Are there questions with that? So that was lump sum sale. So let's talk next about a Section 631B disposal, which is, I understand, the most popular sales method here. Down in the South, the lump sum sale was the most popular instrument. Okay, so this used to be when the owner disposed of timber under a contract that required payment at a specified rate for each unit that was actually cut and measured. That was the old definition up until the end of this past year. So this was commonly called a pay-as-cut contract. Technically, it was a disposal with an economic interest retained, which means that the seller, that's you, typically retains title to the timber and bears the risk of loss until it's actually severed and removed, right? Actually cut. Now it's when the owner either retains an economic interest in the timber, the old definition, or sells it outright. All right, this is the change that was made by the American Jobs Creation Act. Now the section title, but nothing else in the Act, indicates that in the case of an outright sale, the second way now to dispose of timber under 631B, the owner refers to the landowner who makes the original sale. All right, so they were trying to not make this lump sum sale provision available to timber buyers. The Act established then two different ways to dispose of timber under Section 631B. I'm going to discuss the points in that the two ways have in common first, and then points that are unique to the retained interest method of disposal, and followed by points that are unique to the outright sale method of disposal. Okay? So the points common to both methods is, first of all, the seller, that means you, has an investment in the timber and must look to the cutting of that timber for a return from your investment. Timber is the parts of standing trees that's usable for wood products. This includes evergreen or coniferous trees that are more than 6 years old when cut and sold for ornamental purposes. So this is what? Christmas trees, right. So Christmas trees are specifically included in the timber definition of timber in this case. But it doesn't include evergreen trees that are sold live, or the tops of or other parts of standing trees that are utilized separately from the main stem. So it doesn't include live Christmas trees, and it doesn't include greenery. The contract does not have to be written as long as it's enforceable. This is another favorite thing in the tax code. What's the usual rule for an enforceable contract? That it be written, right? So it doesn't have to be written as long as it's written. The contract can include penalties for not cutting certain trees, but only amounts up to the tree's stumpage value is a capital gain. Anything over their actual value is ordinary income. From here, the two methods divide into separate ways. It's kind of like we have a fork now with two tines on it, but as Yogi Berra advises, when you come to a fork, what we do is take it. Okay, so let's take the fork. So points unique to the retained interest method. The owner is any person or legal entity who, before entering into the 631B contract, has the right to cut the timber for sale or use on their own account. So this can be the holder of a sublease or cutting contract as long as they meet the 12-month holding requirement themselves. So I think this goes a long way to helping explain why timber buyers like long cutting contracts. The buyer is obligated to cut the designated trees and purchase them at the price that was specified in the contract. So this is the pay per cut part. Date of disposal, here's our second definition, is not the date that the timber is actually felled, but when in the ordinary course of business the volume of the cut timber is first definitely determined. So that's going to be probably at the mill gate, right, where somebody actually measures it with a stick or by a scale. This definition may enable an owner who has held the timber for nearly the required period, almost 12 months or exactly 12 months, to qualify for long-term capital gain treatment if it's delayed that extra day to help them to enable them to qualify. But the time of measurement cannot be artificially delayed just to get a tax advantage. All right, you can't artificially delay the time of measurement because Darth Vader's evil brother, tax evader, okay. That's tax evasion. The volume of timber cut usually is determined by scaling, but it also can be determined by a cruise that both the buyer and the seller agree to. There was a revenue ruling, it's been around for a long time now, that established that. In this case, the amount disposed of is the cruise volume before the cutting minus the cruise volume of any contract timber that's still remaining after the cutting. Advance payments are permitted. It can be a single sum, so a 631B pay-as-cut disposal can feel a lot like a lump sum payment to the owner. It can even be payments under a long-term contract, as long as the contract specifies that those payments are partial payments for the timber itself, not for a land lease. But the contract for the pay-as-cut fork that we're on now must require adjustments to be made after the cutting is complete, so that the total amount that's paid is determined by the actual timber that's actually removed. Okay, if you include an advance payment from a 631B disposal as a capital gain on your tax return, and the cutting right expires, is terminated or abandoned before all that timber that was paid for is cut, and you're allowed to keep, you don't have to return the excess, all right? You need to file an amended return. Payment for the amount of the timber that was actually cut remains a capital gain, but any additional amount you're allowed to keep is ordinary income. It's not a gift either, it's ordinary income. All right, so that was the points unique to the pay-as-cut branch. fork. Points that are unique to the outright sale fork. Again, the owner is intended to be the landowner who makes the original sale, not the buyer of the timber. Date of disposal, here's our third definition now, is the date that ownership of the timber changes hands. So this is actually the same as it was with a lump sum sale. Okay, a Section 631B disposal provides the seller, again that's you, two important advantages. First, any gain that you realize is treated as a capital gain, regardless of whether you held the timber primarily for sale to customers, even if you're a dealer in standing timber. Okay, so it enables you to qualify, no question, for capital gain treatment. Second, the timber that qualifies under Section 631B is Section 1231 property. So you report the gain or loss from the disposal of your timber on Form 4797, Part 1. It's going to be combined with other Section 1231 gains and losses. And if the result is a net gain, it's treated as a net long-term capital gain and transferred to Part 2 of Form 1040 Schedule D to be combined with other long-term capital gains and losses. So if the result is a net gain, it's a capital gain, which is a good thing, right? It's taxed at the lower rate. If it's a loss, though, if it's a net loss after you do all this combining, it's treated as ordinary income and transferred to Form 4797, Part 2, to be combined with other ordinary gains and losses. So if it's a gain, it's a capital gain. If it's a loss, it's ordinary income, and you can deduct it from income from any source. Okay? It's magic. The magic of Section 1231. All right, so let's sell this timber a second time. Say that instead of accepting the timber buyer's offer, the guy that knocked on your door, you decide to take bids for your timber. A consulting forester solicits the bids, structures the sale as a Section 631B disposal, and administers it all for 10% of the proceeds. The best bid you receive is $295 per thousand and $25 per cord. Let's show how to calculate and report the adjustments to your timber basis and your proceeds from the sale. Okay, so here's what you were accepting on faith so far, is how you would divide your merchantable timber basis between the pulpwood and the saw timber. So how you would do that is you calculate what you would receive if you sold every stick of timber that was in the whole tract. All right, so if you did that, you would receive $14,750 for the pulpwood and $33,040 for the saw timber, for a total of $47,790, of which the $14,750 you would have got for the pulpwood would have been 30.86%, okay? And the amount you would have got for the saw timber would have been 69.14%. So from this exercise, we know that almost 31% of your basis in the merchantable timber account is your basis in pulpwood, and the rest, the 69% plus, is basis in the saw timber. So this is a proportional allocation, just like we did this morning, right, for the different capital accounts. Okay, then you take these different proportions and multiply them times the total basis that's in your merchantable saw timber subaccount. So we have $11,849 of that basis is in the pulpwood, and $26,547 of that basis is in the saw timber. Okay? So now you can calculate your pulpwood depletion unit. You know you have $11,849 of basis allocated to the pulpwood. You know there's 590 cords out there on the whole tract. If you do the division, you see there's $20.08 invested per cord. Okay? Now this is that $20.08 figure you've seen a couple of times now. Okay, that's where it came from. You can also calculate your saw timber depletion unit. So you have $26,547 of basis in the saw timber, and that's allocated over 112,000 board feet. So if you do the division, you have $237.03 invested in each thousand. So that you've seen that figure a couple of times so far. Okay, so your depletion allowance is going to be your investment per cord times the 390 cords that are actually being harvested, plus your investment per thousand times the 112,000 board feet that's being harvested. It's the $34,379, the figure that you've been taking on faith up until now, okay? So you see, it wasn't magic, it was just I just wanted to wait to show you how to calculate it. Okay, so let's update your value basis. You have a total saw timber basis or value basis or cost basis of $38,396, of which you're going to subtract for this sale, for this disposal, $34,379. So you're only going to have $4,017 left. So you see the effect of the first couple, 3 sales. Unless you have a clear cut and wipe it all out, in the first 1 or 2 or 3 sales, you're going to, so even if you don't have a clear cut and wipe it all out all at once, in the first 2 or 3 sales, you're going to basically wipe it out. So to update your pulpwood volume basis, you had 590 cords total, of which we're harvesting 390, so there's going to be 200 left. That's on the younger tract, actually. In the saw timber basis, you had 112 total, of which you're going to harvest all of it, so there'll be none left. So let's fill out Form T Part 2. Okay? So up here, before any of the lines, you would put Scribner decimal C. Down south, it's Doyle. So line 10 is the name of the block, and the name of the block and title of the account, so it's your merchantable timber sub-account. On line 11, the estimated quantity of timber and cost or the basis returnable through depletion is 590 cords, 112,000 board feet. That's the volume basis. And the value or cost basis is $38,396. There's no addition for growth because remember we did this at the end of last year, so there's no additional growth in the month that's occurred since we just last did it. All right, so there's no other adjustments. Total at the end of the tax year is 590 cords, 112,000 board feet, $38,396. Here's the $20.08 figure per cord that you know where it came from now, and here's the $237.03 per thousand figure that now again you know where it came from. It was a proportional allocation of your basis in your merchantable saw timber sub-account. Okay, down here on line, you didn't cut any timber on line 19, but so you don't have any depletion for that. But on line 20, you disposed of timber. You didn't cut it yourself, but you disposed of it. Of 390 cords of the 590 total, and all 112,000 board feet. And the basis in that, remember, is $34,379 that we just calculated. Okay, no other adjustments. So your total reductions at the end of the tax year on line 24 is the same 390 cords, 112,000 board feet, the same $34,379 of cost basis or value basis. And the remainder on line 25 is the 200 cords that's on this younger tract and $4,017 of cost basis or value basis. All right. So line 26, we're going to get to that next time, but not this time. Are there questions with this form? So we've adjusted our basis for the timbers, not a sale, but disposal. Okay, on line 34, it's your timber account. Line 35 is the legal description goes in there, that little space. Line 36A is the buyer's name and address, and 36B is the date of the sale, month, day, and year. Line 37, amount received in cash, is instead of $37,000 is $42,790. So that's the bonus you get for involving a forester in your timber disposal. Okay? It's a fairly modest bonus in this example. I could have made it a bunch bigger and still been realistic. Okay, so no other consideration. So line 39 again is $42,790. Okay, these numbers are exactly the same as they were for the last Form T Part 3. The same 390 cords, $20.08 per cord, $78.32 total. The same 112,000 board feet, $237.03 per thousand, $26,547. The same total on line 40H. All right, your direct sale expenses are different from the last example. Where does this come from? Where does this $4,279 figure come from? Right, that's the consultant's 10%. So it's 10% of this number up here on line 39. All right, so it's a larger number there than the lawyer charges just to look at the contract. But you have more, you have a higher profit than from doing this 631B disposal. It's $4,132. Okay, and you need to write this in hand, income reported on Form 4797, so the IRS guy knows where to look for that. Profit. Okay, he's going to look on Form 4797 now that you just told him. All right, so then let's go right to Form 4797. Okay, so on the top, just like a Schedule A, your name, your Social Security number. Part 1, right, property used in a trade or business held more than 1 year. That's where we want to be. Line 2, the description of the property is merchantable timber. The date acquired and the date sold, the IRS again is going to look and make sure that those are more than 12 months apart. The gross sale price in column D was $42,790. No depreciation because we take a depletion deduction for timber. So in column F, that is the your depletion deduction in the timber plus the consultant's 10%. Okay, so it says basis and expenses of the sale. So that's where both of those things go. The difference then in column G is the $4,132. It'll be combined with any other Section 1231 gains and losses that you have for the year, and the total then on line 7 is going to go to Schedule D. Okay, so it goes from here to Schedule D. 631A transactions. So if you cut standing timber and convert it into logs or other products for sale, all the income that results from that is going to be ordinary income unless you have a Section 631A election in effect. If you do, though, then the income that results from holding the timber is going to be a capital gain, just as if you'd sold it outright. So basically you're selling the timber to yourself and then converting it into products. And the value added from that second stage, the value added from converting the timber into products for sale, that's going to be ordinary income. It's always ordinary income. It's never a capital gain. You report a Section 631A transaction then in 2 parts. You report the difference between your adjusted basis and the timber that was cut and its fair market value as a Section 631A gain. It's going to be aggregated with other Section 1231 gains and losses that you may have. And the net gain then is treated as a long-term capital gain, and a net loss is treated as ordinary income. Remember, this is the magic of Section 1231. You always, no matter what your outcome is, profit or loss, the type of income you have is always the type of income that does you the most good or the least bad. And then you report, the second step is that you report the profit from the conversion of the standing timber as ordinary income. And you determine the profit just as you would for any business operation. It's your income received from the sale of the products minus the fair market value of the timber and also minus the cost of the conversion. The owner is the same as it would be with the 631B disposal with economic interest retained. So again, it can be the holder of a sublease or cutting contract. It cannot be the holder of a cutting service contract who's obligated to deliver the logs back to you or to a buyer that you specify. That person's doing a service for you, right? They're working for you. They're not an independent operator. Even if the contract that you have with them uses terms like buy and sell and stumpage charges, that's just smoke. This person's really working for you. They're not working on their own. Timber also means the same as it would with a 631B disposal. Timber cut by taxpayer includes timber that's cut by other persons at your direction, as well as timber that you actually physically cut yourself. So you don't have to go out there and saw down the trees yourself. You can hire somebody to do it. The products the timber is converted into can either be rough, logs, pulpwood, or firewood, or finished, lumber, wooden toys, or furniture, or anything in between. Just products that you can sell. But they must be for sale or use in your trade or business. They cannot be products that you use for your personal use, for firewood that you use yourself, or barn poles that you use yourself. Holding period. This is runs from the day that you acquired the timber or the contract right to cut it until the date that it is cut. As with the 631B disposal, this is when in the ordinary course of business the volume of that timber cut is first definitely determined. Fair market value is the price at which the timber would have changed hands in a transaction between a willing, informed buyer and a willing, informed seller on the first day of the tax year on which it is cut. So this is going to give us a new definition of data disposal that I'm going to get to in a minute. So the timber has to be valued as it existed on that day, regardless of any changes that occur to the timber itself or to the market between that day and the time that it's cut. The best indicator of this fair market value is the actual price that's paid for similar timber in the same area at the same time of year, adjusted for any differences in quantity, quality, accessibility, and markets, and that figure discounted back then to the first day of your tax year. A general average price is not sufficient. If you're only cutting a small amount of timber, information that you receive from a local mill operator or a local timber buyer probably is good enough, but if you're in the business of cutting large amounts and converting large amounts of timber, you need to use a qualified timber appraiser to set that transaction value. Okay? Again, because the higher the figure that you're talking about, the better you need to be able to justify it to the IRS, because there's a new form that we haven't talked about so far. Okay? That the IRS is asking his assistant to get him right there. It's called the gotcha form. Okay? You don't want to ever see a gotcha form. Now, anybody's taking valuation, and I'm assuming that's a bunch of us in the room here, you know that unless there's an actual cash transaction and money changes hands, that the best you can do to estimate the value of an asset is there's going to be somewhere in a range. Okay? There's a high end to the range and there's a low end to the range. Now, where... And you get above that, and it's ridiculously high, and you get below that, it's ridiculously low, and you cannot pass what I like to call a laugh out loud test. Okay, but where in that range would you like your transfer price, the price that you're selling timber to yourself, to be? At the high end of the range or the low end of the range? High end, at the high end of the range, and why is that? You want it at the high end in order to make as much of your income as possible a capital gain, right? If you charge yourself a high stumpage, as high as possible stumpage price, right? That's going to put more of the income from the whole transaction up into the capital gain category instead of being ordinary income from the sale of the converted products. Okay, so you want as much as possible to be capital gain, as little as possible to be ordinary income. Okay, the deal is you need to stay within the range, because we talked about earlier about the IRS foresters who are still there. The biggest part of their job is to check up on corporations, right? And what they're checking is the transfer price, what they're selling their own timber to themselves for, making sure that that's a reasonable number, okay? And so they have a similar interest in the transfer price to individual landowners, okay? So you want it as high in the range as possible, but still in the range. Okay, because then you go from tax avoidance to tax evasion, where you don't want to be. Where you make a 631A election is by checking the yes box on line 27 of Form T Part 2, and I'm going to show you exactly where that is, since it's so important. And you need to make this election on an original, timely filed return. So this can include extensions, but it needs to be original and timely filed. You cannot make this election on an amended return. So if you forget to check this box on your first return that you send in, you've lost that opportunity, and all the income from this transaction is going to be ordinary income. Okay? No part of it's going to be capital gain, and that would be terrible. A 631A election is binding on all timber that you cut and convert into products in the year that you make that election, and in all later years. Now, going back a little bit in history, owners who cut timber under a 631A election that they made before January 1st, 1987 could revoke it one time without IRS consent. Okay? That was the Tax Reform Act of 86. Okay? The new act, our newest act, does the same thing. Under the American Jobs Creation Act, owners who cut timber under a 631A election that they made before January 1st of this year can again revoke it one time without IRS consent. In all of the situations, you need to get the IRS's consent for you to revoke a 631A election. This provision chiefly benefits corporations, but it also will also help non-industrial owners who, because of their particular tax situation, the facts and circumstances of their case, would benefit from making such an election. Yeah, Lloyd. Okay, how you do this is you attach a statement to your tax return on a plain piece of paper, the Form 3P. No consent is required to reinstate a 631A election, so you can do that anytime you want. Any further revocation, though, does require IRS consent, but remember, this is what you ask. You can dispose of standing timber lump sum or under 631B at any time. It doesn't affect sales or disposals of standing timber, just cut timber. You report the timber cutting part of this transaction on Form 4797. It's going to be, again, combined with other Section 1231 gains and losses and a net gain transferred to Form 1040 Schedule D as a capital gain, and a net loss transferred to Form 47 Part 2. Remember, again, as ordinary income. You report the conversion part of the transaction on a business schedule. Schedule C if you have a timber business, a Schedule F if you're a farmer. And I want to emphasize that in all these situations where you're filing Schedule F, this means a farmer in the traditional sense, where you have field crops or grazing or something that someone would consider an ordinary agricultural product. Schedule F doesn't mean tree farmers, okay? Tree farmers don't, if all you have is a tree farm and that's the only thing that you own that has anything farm about it, you don't need to be using Schedule F, all right? If you're using Schedule F and you're a tree farmer and you do everything right, there's no difference between using Schedule F and Schedule C. The deal is that farmers have access to provisions that other people don't, and you might make a mistake and use something that's only supposed to be available to farmers in the traditional sense, and then you've gone, again, from tax avoidance to tax evasion, even if it's inadvertent. Okay, for a 631A transaction, you list the fair market value of the timber that's cut and the other costs associated with the harvest and sale as other expenses on the Schedule D. And you include attachments giving the details of the cutting and the sale with your tax return. Up to now, you could do that on a plain piece of paper, but now, later on at the end of this talk, toward the end of this talk, I'm going to talk about why it's important to use Form T Part 2. You include information that you use to estimate the fair market value of the timber that was cut. This is your transfer price. You need to support that, right? All right, so let's cut this timber a third way, and say that instead of selling your timber as stumpage, you hire a master logger. Do we have master loggers here? No? Okay. So this is like a science fiction future example. To harvest it, cut it into saw logs and pulpwood, and deliver the cut products to a sawmill that you specify. So this person is working for you, right? There's no question. The consultant charges you $600 for having solicited all those bids that now you're ignoring them. But you do have, that does help you set your transfer price, right? From the bids then, you know you have $295 per thousand is the value of the standing timber, and $25 per cord is the value of the pulpwood. Okay, so you have no trouble justifying your transfer price since you paid $600 to get it. Okay, the master logger, though, charges you $22,500 for everything that he does for you, and you receive $390 per thousand and $60 per cord. So this is the increase in value of selling cut products rather than stumpage for those delivered products. So show how to calculate and report your gains. So the first thing, again, that you would do is to calculate your timber depletion allowance and adjust your timber basis, but you already know how to do that from the 631B example. So we're not going to do that again, but there is another Form T Part 2 in there. Go up here on line 18 and 19. So the quantity of timber cut, which was on line 20 before, is up here on line 18. 390 cords and 112,000 board feet. And your basis in that timber, the $34,379, is up here on line 19 rather than down here on line 21. Okay, so that's one difference between the two forms. And the other difference is now we have an entry on line 26, the quantity of cut timber that was sold as logs or other rough products. That's all of it, 390 cords and 112,000 board feet. So those are a couple of fairly minor differences that were on Form T Part 2, but the big thing I want to show you is here. Line 27, are you electing or have you made an election in a prior tax year that's in effect to report the gain or loss from cutting a timber under 631A? And this is where you check this box. This is where you make the election. And remember, it needs to be on an original, timely filed return, or else you've lost the chance to make that election, and all your income, every penny, is ordinary income. None of it is capital gain. Okay, so you got to make sure to check this box. Okay, now let's calculate your Section 1231 gain from holding that timber. So its fair market value as of January 1st was the $42,790 that you would have received if you'd got it, if you'd sold it under 631B, disposed of it, minus the consultant's fee, minus your depletion allowance, right? And we know now where this number came from. So you have a Section 1231 gain of, rather than $4,000, it's way up here almost $8,000, $7,811. So that's the extra amount that you make for having gone to all the trouble to cut the timber yourself and convert it into products. You make some extra money. And where you report that, again, is on Form T, Part 3. Now, when I taught college, I always prided myself on not asking trick questions, but here's a trick question. All right, line 34 we're familiar with. It's your timber account. Line 35 is a legal description. Again, squeeze into that little space. On line 36A, it says your name and address. Is that a typo? I've already had one typo, but is this a typo? Who's the purchaser? You are. You're selling it to yourself, right? So your name and address goes here again. Oh, shoot, here is a typo. What's the date of sale? First of your tax year. If you're a calendar year taxpayer, this is 0101 of whatever year you're in. So this should say 0101YY. Line 37, the amount that you received, with the amount that you're actually kind of paying yourself is the $42,790 that you would have got from the 631B transaction disposal. Again, you can't type a number in that box. So this looks exactly the same as it did at the last example. This looks exactly like it did in the last example on lines 40D. So your basis on line 40H is exactly like it was in the last example. This is different, though. Instead of the consultant's 10% that he would have charged you in the disposal, this is what? That's his fee for soliciting the bids for you, right? Okay, so that's a smaller number. And that's why you have a larger number here, $7,811 on line 41. And again, you want to write in on the dotted line, income is reported on Form 4797. Okay, so let's go ahead and report that income on Form 4797. So again, at the top, it's just like you're doing a Schedule A. You put your name and your Social Security number up there. On line 2, here we are in Part 1. Property used in a trade or business held more than 1 year. That's where you want to be. Column A, description of the property is merchantable timber. Column B is the month, day, and year that you acquired it. The date sold is 0101 of the year that you're filing for. All right, your gross sale price is, unless you're not a calendar year taxpayer, you have some other tax year, but most of us are calendar year taxpayers. Column D is the gross sales price. This is the amount that this is your transfer price that you're selling the timber to yourself for. Your basis and your expenses of the sale. So this is your basis in the timber plus the consultant's $600. So your gain is the $7,811. Okay, so it'll be combined with any other Section 1231 gains or losses that you have during the year, and the total there on line 7 is going to go to Schedule D as a capital gain. Continuing the solution, then we need to calculate your gain from selling those converted saw logs and pulpwood. Okay, so your sale proceeds at the mill gate is $67,080 minus the fair market value of the timber, the $42,790, the transfer price for that timber as stumpage, minus the master logger's fee that he charged you. So you have an additional $1,790 of ordinary income from this 631A transaction. Okay, and where we show that is on Form 1040 Schedule C. Okay, again, your name and your Social Security number goes up at the top. On line A, you want to put what your principal business or profession is, and I put down timber management for profit to show a profit motive. There's a code to put in here in line B, and the code for forestry and logging is 113000. Okay? So that's secret knowledge that not everybody knows. So you don't have to read the instructions to find out what that code is. It's right there for you. If you want to have a nice business name, you can put it in there on line C. Your address on line E. This is the line that Larry was talking about. Your accounting, no, it's not yet. This is the one that I talked about earlier. Your accounting method probably is going to be cash. This is the one that Larry was talking about. Did you materially participate? And you need to be able to say yes. Okay? You want to be able to say yes. Okay, income is the $67,080 you got from the mill. No returns or allowances, so it's the same $67,080 on line 3. Line 4 is your cost of goods sold. That's going to come from the back, but it's $65,290. We know that from the worksheet. So your gross profit is $1,790. No other income to report, so your gross income is $1,790. There's no expenses that aren't reported on the back on line, so there's nothing in line 27 or 28. So your tentative profit is $1,790. On line 30, I'm staying strictly away from business use of your home. So line 31 again is $1,790. You want to put this number in two places. The first place you want to go is Form 1040 line 12 and write that number in, but also on Schedule SE. So on this number you pay self-employment tax and state income tax. Okay, now the back of the form, okay, your method to value your closing inventory, you're not actually going to have a closing inventory, so let's keep it simple and say cost. And again, it's simpler if you, on line 34, changes to determining quantities if you say no. Okay, so your inventory at the beginning of the year was $42,790. That's how much the products, the cut products, is that what the cut products? No, that's how much, that's the fair market value of the timber, right? And on line 37 is the labor cost is the master logger's fee. So those two numbers add up together to $65,290. There's no ending inventory, so on line 42, your cost of goods sold is the same, $65,290. So basically it's two numbers that you had to start with. There's only one place to put them. Okay, so all of that was, I'm not ready for that one. I only got a cartoon. So that $1,790 is disposable income, of course, but disposable income is sometimes it's hard to find. I'm sure that's a problem we all share, right? So Form T was revised in October 2003, just a couple of years ago, to make it compatible with electronic filing. That was the specific goal of this revision. But the Who Must File section addresses the confusion that we had with earlier Form Ts about who must file this form and when. Okay? You must file a Form T if you claim a timber depletion deduction or if you make or use a Section 631A election. Now, both of those activities, as we saw, only involve Part 2 of the form. There are lots of other activities that are covered by other parts of Form T that, if you do one of those, you should fill out that associated part. Okay, if you buy timber or cutting contracts or forest land, you should fill out Part 1. If you sell timber or forest land, you should fill out Part 2. If you do silvicultural practices, you should fill out Part 4. Or if you make adjustments to your land account, you should fill out Part 5. But what you do with those filled out parts depends. If you claim a timber depletion deduction, or if you make or use a Section 631, that should say A, not S, election, you have to file a Part 2. So you file Part 2 along with any of those other parts that are associated with forest-related activities that you did during the year. Now, along with Part 2, you're always going to have a Part 3. If you don't have to file a Part 2. If you don't do those activities and need to file a Part 2, you just hang on to those other parts. You don't send them in, okay? So that's your documentation for having done those activities, okay? So you fill out the form fill out the part of the form that relates to any activities you do during the year. If you do anything with Form T Part 2, you file everything for all your activities you did that year. If you don't file a Form T Part 2, you just hang on to them. Owners who only have an occasional timber sale are not required to file a Form T at all, although IRS foresters think it would be prudent to do so. Okay? So what are you going to do if you're a prudent landowner? You're going to ignore this part of the instructions and file it anyway, right? Okay. Now the Who Must File section also includes the only written guidance that we have from the IRS on what constitutes an occasional timber sale. We used to say once or twice during your lifetime or every several years. But what does it say in there? This is another example where the IRS interpretation is way more liberal than we've been thinking all along. It says 1 or 2 sales every 3 or 4 years. So you could sell timber every other year, and it's an occasional sale. Okay, so landowners down south are really concerned about what's an occasional sale, or they were up to the beginning of this year. So we used to say once or twice during your lifetime, or every several years, but now every other year is an occasional sale. So you could sell lump sum every other year and have it be an occasional sale. The lump sum income from a lump sum sale would be capital gain. Okay, that's way more liberal than we thought it would be. Oh, just my little vanity thing here is I want you to note down here on the bottom left, on the right-hand column toward the bottom, where under additional information, that's where it says Ag Handbook 718 is where to look for additional information. Okay, so that's my publication. So I want you to know. Okay, I have a little summary of cost information that I'm not going to go over. We've done enough about that. But I wanted to talk about information returns. The timber buyers in a 631B disposal are required to report their payments on a 1099-S unless the seller is a corporation. So if you're an individual landowner and you sell your timber under, or dispose of your timber technically, under 631B, the provisions of 631B, you're going to receive a 1099 from the company that bought it, and the IRS is going to know you have that income, right? Now, we have all kinds of landowners who that weren't selling under 631B before if they sold lump sum. Now, for an outright sale, that also qualifies under 631B. So all these landowners who sell pay-as-cut, they're under 631B. And now all the landowners who make outright sales, lump sum sales, are under 631B if they want to be. Okay? And they're going to receive a 1099. So the IRS kind of got a little coup in here. They're going to have 1099s and reported income for all these sales that weren't reported before. Okay? Because buyers of standing or cut timber for a lump sum were not required to file a Form 1099. Okay? So we had all kinds of owners who were making lump sum sales and they weren't getting a 1099 for it. And the IRS did a couple of compliance studies, well, 2 or 3, in Washington State, West Virginia, and in New York most recently. And they found out that the compliance rates, what I'm talking about is the percentage of landowners who remembered that they had a timber sale in the last year, was down around 40%. So between 20 and 40%. So something like 2/3 to 3/4 of the forest owners forgot that they had that timber sale. And they forgot where that money came from. Between the time they made the sale and the time they had to report it several months later on their income tax. So we're a forgetful bunch. So the IRS, I'm sure, is very happy to have outright sales included under 631B. That's going to generate a whole bunch more 1099s and have reported income.